Hey everyone, let's just jump right into this explainer for the week ending June 12th, 2026. Look, if you've been watching the tickers lately, you know we're in the middle of a massive market transition. We're literally watching a generational shift in capital allocation play out in real time. So, we're going to map out exactly what happened and, more importantly, what it means for your portfolio. The ground is definitely shifting beneath our feet right now, and well, we need to know where it's going to settle. Okay, here is the roadmap for today. We've got the historic SpaceX IPO, the shifting market tightens, a warning for the wearable sector, some major moves in geopolitics and commodities, and finally, all eyes on the Fed. So let's start right at the epicenter of this week's financial earthquake. Section 1, the historic SpaceX IPO. $2.1 trillion. I mean, just let that sink in for a second. That staggering number is the day one market capitalization for SpaceX. Seriously, traditional ways of calculating a company's worth, you can pretty much just toss those out the window at this point. We are completely off the old valuation maps here. But hey, when a company literally builds rockets, I guess it kind of makes sense that their valuation defies gravity, right? The sheer scale of this debut is just wild. The stock absolutely blasted off from its $135 IPO price, surging 19% to close out at roughly $161 a share. So why the massive premium? Well, investors are pricing in a totally jaw-dropping, total addressable aerospace market. We're talking $28.5 trillion. That heavy institutional demand completely redefined the entire sector in a single trading session. It absolutely proves that the appetite for space infrastructure is, frankly, ravenous. Now, an entry this huge doesn't just happen in a vacuum. It forces a massive reshuffling at the very top of the broader market, which brings us to Section 2, shifting market titans. We are literally watching a changing of the guard. We all know the Magnificent Seven, right? Well, SpaceX's $2.1 trillion entry just officially vaulted it into the number 6 spot of the most valuable U.S. companies. And right down there at rank 8, yeah, that's Tesla, sitting at $1.53 trillion. So Elon Musk's two major gambits have actually swapped places, bumping Tesla entirely out of that top tier. It's almost like a sibling rivalry playing out on the absolute biggest financial stage in the world. But, the mechanics behind this launch are just as important as the numbers themselves. Fidelity reported that literally 100% of their brokerage customers who wanted in actually got to participate. It was a remarkably smooth, democratized rollout. And that massive day one surge officially cemented Elon Musk as the world's very first trillionaire, thanks to him owning both the number 6 and number 8 most valuable companies in the country. But here's the real takeaway for the broader tech space. This totally validates the mega IPO. Seeing this massive investor appetite could absolutely encourage AI heavyweights, think Anthropic or OpenAI, to hit the gas on their own public timelines. The race to dominate the AI market just got a huge injection of public market FOMO. It's not all rocket ships and trillion-dollar valuations, though. While the mega IPOs are crushing it, there is a serious storm brewing for specific hardware sectors trying to make the leap from private darling to public longevity. Let's look at Section 3, the wearables warning. So there's a really crucial vulnerability shared between these two extremes. On the one hand, you've got the current VC hype, right? Players like Aura and Whoop are seeing these soaring private valuations because everybody wants a consumer health tracker right now. But on the flip side, we have the historical reality of companies like Peloton. We all remember those post-IPO struggles, trying to turn that early buzz into lasting public growth. The common denominator here, they're hardware companies that desperately rely on recurring subscription revenue to sustain hypergrowth. As we scan the IPO radar, those specific business models are facing some severe headwinds when moving to the public sphere. Because let's be real, hype in the private sector definitely doesn't guarantee patience from public markets. Let's pivot for a second and zoom out from tech. We really need to look at the global board, where a major diplomatic breakthrough is sending immediate shockwaves through the energy sector. Section 4, Geopolitics and Global Commodities. Looking impartially at this geopolitical catalyst, there's a really clear 4-step chain reaction unfolding. First, a U.S.-Iran peace deal is nearing completion. Second, the terms state that Iran agrees to destroy its stockpiles of highly enriched uranium and halt nuclear weapons development. Third, in exchange for that, the U.S. grants significant sanctions relief. And fourth, the market reaction. Anticipating a bump in oil supply from the region, mixed with those easing tensions, drives an immediate sell-off in the energy markets. The immediate real-world result of that impending sanctions relief, a sharp 3.4% drop in Brent crude oil this past Friday. It brought the price down to exactly $84.38. It's really a textbook example of how fast global commodity markets can cool off when we see major geopolitical thaws. Honestly, for anyone actively tracking inflation right now, a drop in crude like this is a pretty massive sigh of relief. Finally, we need to look ahead to the ultimate macro driver of the U.S. economy. As the dust settles on all these historic events, everybody's looking at the central bank. Section 5, Eyes on the Fed. Mapping out the tactical calendar for the week of June 15th through the 19th. Monday is looking pretty quiet with just some housing market and industrial production data. But it's super clear that all the real attention is focused squarely on Wednesday. And keep in mind, this is a holiday-shortened week since the markets are closed on Friday for Juneteenth. That naturally condenses all the trading action, and let's be honest, all the anxiety, right into the middle of the week. It's going to be a bit of a pressure cooker. So, what exactly are we watching for on Wednesday? Well, the baseline expectation is actually kind of boring. The federal funds rate is widely expected to stay completely unchanged. But the market isn't looking for a rate cut right now. It is desperate to decode the specific economic philosophies of the newly appointed Fed chair, Kevin Warsh. Wall Street wants critical clarity on three main things during his press conference: the future state of the Fed's balance sheet, forward guidance on the trajectory of interest rates, and exactly which specific inflation measures the new chair favors. This one press conference is absolutely going to set the tone for the entire back half of the year, so we really need to pay close attention to his exact wording. To wrap up this explainer, I want to leave you with this synthesis. We are clearly in a market transition. Geopolitics are cooling off commodities, while U.S. tech is going through a literal generational changing of the guard. So, here's the provocative thought I want to leave you with this week. Will the incoming rate guidance from Chair Warsh provide the exact macroeconomic fuel we need to birth our next generation of market titans? Keep a really close eye on those AI darlings we talked about, because the Fed's words on Wednesday might just be the exact launch pad they've been waiting for. Thanks so much for learning with me today, and I'll catch you on the next explainer.